If you think the silver market crash was just another chart pattern or short-term panic, stop. Because this is not really about silver, it is about you, your money, and the quiet decisions you keep postponing while telling yourself you will figure it out later, because while headlines screamed volatility and social media argued over price targets, something far more damaging was happening underneath. Long-term wealth was being quietly destroyed, not by the crash itself, but by misunderstanding it. And here's the uncomfortable truth most people avoid: the silver crash was not random chaos or a temporary dip meant to scare weak hands. It was a test of financial literacy, patience, and identity. And most people failed it without realizing they were even being tested. Because while silver slid and exhausted investors, most Americans were distracted by credit card balances creeping past $8,000, rent pushing $2,000 a month in major metro areas, $700 car payments, student loans restarting, groceries costing roughly 30% more than just a few years ago. And in that fog, people reacted emotionally instead of strategically, selling fear, buying hope, and calling it investing. But the real bottom in silver, the level that actually mattered, was not where most people felt safe or where charts were screaming. It was lower, quieter, and psychologically brutal, because true bottoms never feel comfortable. They feel wrong. They punish hesitation, and that is why so many miss them, not because they were unintelligent, but because they were conditioned by paycheck-to-paycheck living, instant gratification, and a system that trains reaction instead of thought. Because when your financial life is reactive, reacting to bills, inflation, and headlines, you are not investing. You are participating in controlled chaos, and silver exposed that difference clearly, because when silver approached levels that historically signal long-term value, most people were not asking what this meant over 5 or 10 years. They were asking, what if it goes lower tomorrow? And that single question reveals everything about mindset, because short-term fear always sounds rational, but long-term regret is what it compounds into, and this is where $75 matters. Not as a guaranteed future price, but as a psychological anchor for what investors misunderstood about cycles. Because markets do not reward prediction, they reward positioning, and the positioning window was quiet, uncomfortable, and came without confirmation, when sentiment was exhausted and no one wanted to talk about metals anymore, exactly when the average American was too busy worrying about their next emergency to notice opportunity. Because value never announces itself loudly. It whispers while fear is shouting, and most people cannot hear whispers when their financial life is already screaming, so they rotated into what felt emotionally safe, held cash losing purchasing power to inflation, chased short-term bounces, or froze entirely, because paralysis feels safer than decision-making, and in that paralysis, opportunity dies silently because the market does not care about your rent, your debt, or your stress. It only responds to supply, demand, psychology, and time, and silver revealed a hard truth. Most people do not have an investment strategy. They have a hope strategy. Hoping prices recover, hoping retirement works itself out, hoping inflation slows before it erases another decade of purchasing power. But hope is not a plan. It is what you cling to when reality has been avoided too long, and the deeper reason $75 mattered was not certainty, it was identity. It required someone who understood volatility cycles, and that discomfort is the entry fee for long-term gains, something most people are trained to avoid: swipe now, pay later, refinance, stretch payments, push responsibility forward, then wait for confirmation and safety in investing, and by the time everyone agrees, the opportunity is already gone, because markets move ahead of comfort, not behind it. And while analysts debated technicals, the real story was psychological exhaustion. When an asset underperforms long enough that people stop caring, weak hands leave, sellers exhaust themselves, and long-term capital positions quietly. A phase most retail investors never see because they watch with anxiety. Checking prices between work shifts and bills, and anxiety shortens time horizons, turning every dip into a threat instead of a setup. So ask yourself honestly how many times you waited for clarity that never came. How many times you said you would act when it felt safer, only to realize safety arrived after the upside was gone, because that pattern shows up everywhere. Careers, savings, retirement, and silver simply exposed it clearly. And this is where the post-crash phase becomes decisive, because after panic fades, the real danger is complacency. The belief that the moment passed or there will be another chance, and that belief quietly disqualifies people from long-term wealth. Because while silver stabilized and sentiment stayed numb, most investors mentally checked out, not because opportunity vanished, but because their attention span did. And this reveals the core trap of modern American finance, the inability to sit with uncertainty long enough for compounding to work, in a system that trains immediate feedback and reaction. So when investing requires patience without reassurance, silence feels like danger. Even though silence is where intentional investors separate themselves, because those who understood why $75 mattered were not excited or celebrating, they were calm, allocating slowly. Understanding wealth is built through long stretches of discipline that feel uneventful, and if your financial life is chaotic, your investing will be too. Thin savings, heavy debt, and short planning horizons create emotional pressure that leads to chasing instead of positioning, panic instead of preparation, and hope instead of decision. And silver revealed that misalignment because people treated stabilization as a signal to disengage, as if lack of drama meant lack of opportunity, when disciplined investors do not need excitement, they need alignment between time horizon, risk tolerance, and understanding of cycles. Cycles that drift quietly until narratives change and everyone pretends it was obvious. And inflation does not pause while you wait for confidence. Debt does not get cheaper while you sit out, and time does not slow down because you feel uncertain. So the real choice is identity-based, needing emotional permission to act, or building systems that make emotion irrelevant, because passivity in a system designed to erode purchasing power is still a decision. And the silver crash was never just about silver. It was a mirror reflecting whether you operate intentionally or reactively, whether you prepare or predict, whether you build margin or burn it, because margin is what lets you sit through drawdowns, allocate during boredom, and hold through uncertainty, and building margin is unglamorous. Living slightly below your means, paying down high-interest debt, automating savings, extending your time horizon, and accepting that real wealth feels slow at first. And if this makes you uncomfortable, that is the point, because discomfort signals confrontation with avoidance, and the real decision has nothing to do with where silver goes next month or next year. It has everything to do with whether you are ready to stop outsourcing responsibility to headlines and hope, because the investors who win long-term are not the ones who guess right. They are the ones who stay aligned, disciplined, and present when everyone else drifts. And once you see that, every financial decision becomes a reflection of who you are becoming, not just what you think the market will do next.